Stuart McPhee here, and I'm coming to you from Hong Kong this morning. I'm spending a couple of days here in Hong Kong before I head to China for the weekend to speak at an event, and I'm joined by Ray Barros, one of my mentors who happens to live in Hong Kong. And Ray, thanks very much for joining me, and I know your time is limited, so thanks for giving me the opportunity to speak to you today. For those who don't know Ray, correct me if I'm wrong here, Ray, but you were a lawyer by trade, I guess, and did university and had your own practice, law practice, started trading early 70s, gave up the practice in early 80s and really took on trading as a full-time role. So we're talking back in early 80s, so we're talking many, many years, and you've written many books and do a lot of speaking circuits, speaking things around the world, and you've certainly been in the market a long time. So thanks for joining me. Now, I also know you manage funds, and I think people in my position, that's something that we aspire to is to get other people's money and have people put trust in us to manage their money, and I know you do that. Just before we start, do you perhaps approach managing funds slightly different, like a methodology-wise, and say if you're trading your own account? Is there differences in the way you do it?
There is a difference in terms of the amount of risk you can take for clients. So that's about the only difference. I'm a little bit more aggressive on my own account. I know what my risk tolerance is. Clients are less willing to lose money, if I can put it that way.
Yeah, I understand.
So you want to manage the risk a little bit more carefully and reduce their exposure a little bit. So, with my clients, I'm happy to make somewhere between 20 to 25% per annum. I push the boundaries a little bit on my own account.
Yeah, I think the key word you said in was tolerance, wasn't it? If you lose some money, you sort of can deal with it, but if you then have to front up to other people and let them know, oh, by the way, we've had a bad quarter, that tolerance, you don't know where their tolerance sits so far as losing money. So
yeah, well, part of the problems you face when you're managing money is the fact that you only have to have a couple of losing months and they're ready to withdraw. And I get around that problem by tying people up for 3 years. They can't take their money out.
Sure. Okay, well, that's probably good advice. Should I ever manage funds in the future? Just tie them up?
Give them a stop loss. I mean, we have a maximum loss of 30% of initial capital or peak equity, whichever is the greater.
Right.
So, they have a built-in, the maximum they can lose is 30% of the capital.
Right.
And so far, not wood, that's never occurred. We tie them up for 3 to 5 years, depending on who they are. Singaporeans, for example, are less willing to tie up for 5 years. I prefer 5 because if you can have a 20% per annum return, you will double your money in that period.
Sure. Okay, which is appealing to anyone, I guess.
Exactly.
And look, Ray, I've heard you speak at many events, trading events and the like, and I reckon one of your, I don't know if you've ever advertised this, but I think one of your pet topics that you really like to talk about is managing risk. Are you able to perhaps comment on why that's such a pet topic of yours, and what advice you'd have to people about managing risk and why it's so important?
Well, I think it comes from my background. I mean, I started off, I sold the legal practice, and in 12 months blew that in trading.
Wow.
I just said in my blog, we're doing the hero's journey at the moment in the blog, and if you have a chance to have a read of it, it's quite an interesting thing. And what I tell you there is that Christine, my wife, was the one that funded me until I started to become successful. I can't tell you the amount of money that I went through. I mean, I blew a lot of money. And it was because I didn't manage my risk. I followed the systems all right. I would follow my rules. That was never too much of an issue. The rules may or may not work, but that following the rules wasn't an issue. I just wouldn't manage my position sizing, and I wouldn't manage my losses. So to me, that's where the consistent execution of your risk management is where the profits are. The plan is fine, but any plan with any sort of edge will get you some return. So that's why I focus on risk so much.
So it really came from some difficulties or challenges early on where you were almost forced upon to recognise and appreciate how important managing risk was.
Absolutely.
Was that position sizing? Was it, so where do you set your stops, or what specifically did
it was
all the above?
Except for the stops. I mean, the stops, I didn't manage the stops initially, and then I felt, well, this is a sucker's game because you read every book to put the stops in. But then I didn't manage portfolio risk. If you're spread over a number of instruments, how much of, even if you risk 2% per instrument, and you've got 20 instruments open, suddenly you've got 20% open.
Yes.
So you got to have that. You got to have how much you're going to risk per trade, how many contracts you're going to take. So all of those things I had to learn the hard way.
I'm sorry to hear that, but I think a lot of people go through that, don't they? A lot of people make a lot of mistakes early on, and it's only through making those mistakes yourself I mean, you can read 20 books that say, you know, position size well and do this, and you sort of go, yeah, I'm sure it's important, but I'll deal with that later. But then you go through it yourself, make all those mistakes, and it hurts. And what you said was, you know, Chris, your wife, funded you early on, and that probably didn't sit terribly well with you. So it forces you to, I guess, recognise that they're important.
And I think earlier on, we were, you know, a couple of times we've chatted, I've mentioned to you that I have an excuse, you see. I can say that back in my day, no one was there to really assist.
Yes.
I mean, the stuff we had, there's nothing compared to the assistance you get today. I mean, you get some really good people out there trying to help. In my day, the first person that I came across was Pete Settlemyer, and that was a good almost 7 years before I had been losing this money. So.
Okay, so it's a real big difference now, which is terrific. Off risk management, and you and I both know how important that is, and I hope others, you know, realise how important managing risk is. But a lot of questions we get from clients, it's all about entry. And you know, you do the seminar thing, and someone will talk about managing risk, and you might have a good size audience, but then someone else is talking about, you know, something entry, and the room, it's standing room only because everyone wants, because this is the key to success. What are your thoughts on entry and why people focus on it so much? And do you have guidance to people about entry and methodologies and setups and all that?
Yeah, I think they have a place. I think your trading set of rules, entry has probably the least important part. In my view, identifying whether the trend's going to continue or change, where you're going to take a trade, and whether that trade's setting up is much more important. The entry almost necessarily follows those things.
Okay.
Secondly, you're never ever going to, well, I've been 30 years in the markets. I've sold the exact high once, and I can't remember when I bought the low. I don't think I've ever done it. So at some point after entering the market, you're going to take some heat. So you need to know with your methodology how much heat is normal. And so what John Sweeney wrote a book called Maximum Adverse Excursion, Maximum Favorable Excursion. I would recommend that to anybody that is talking about trading and talking about entry, because that approach identifies statistically how much heat you ought to be able to take in your system and still make a profit. Now, if you know that, it takes the pressure away from I've got to buy the exact low, or I'm going to buy it within 2 ticks or sell it within 2 ticks. And often some systems just aren't geared for that sort of thing.